Hi guys, in today's video we will explore some major historic crashes and the key lessons we can learn from those. There's no doubt that market crashes can be devastating, but they also provide us with valuable insights into the world of investing. So let's dive into the actual data of some historic market crashes to illustrate the intensity of those. In the 1929 Great Depression, the stock market crashed by 89%, wiping billions of dollars in wealth. Investors who were heavily concentrated in stocks paid a heavy price for not diversifying their portfolios. The Great Depression of 1929 happened due to excessive speculation and stock market crashes, which resulted in massive unemployment and bankruptcy caused by overbuying stocks on margin. During the dot-com bubble in the late 1990s, the Nasdaq Composite Index lost about 78% of its value in just over 2 years. This bubble burst in the early 2000s, with the overvaluation of internet-related stocks leading to a massive market downturn. This crash taught us the dangers of investing in solely speculative tech stocks without considering the fundamentals. In 2008, the global financial crisis occurred due to subprime mortgage lending, which eventually caused a collapse in the housing market. The burst of the real estate bubble occurred due to loose mortgage standards and a sudden decline in property values. This global financial crisis of 2008 brought down major banks and caused recession in many countries. Housing prices plummeted and stock markets experienced substantial declines as investors' confidence was shattered. Many investors lost a significant portion of their savings due to poor diversification and excessive risk taking. Looking at these crashes, we can see the importance of not trying to time the market. Even the most seasoned investors struggle to predict such downturns accurately. By having a long-term investment strategy, we allow our investments to recover even after significant market downturn. Emotions can play a significant role in investment decisions during market crashes. Fear and panic can lead to selling investments at the bottom and missing on potential recoveries. It's crucial to stay calm and rational, focus on the long-term prospects of our investments. Learning from history is essential to navigate through market crashes. By analyzing the patterns and causes of these crashes, we can better understand how to prepare for future uncertainties. So, to sum up the video, we can learn 5 important financial lessons from historic market crashes. Lesson number 1. Diversification is key. Spreading your investments across different asset classes helps protect against severe losses. Lesson number 2. Don't time the market. Trying to predict when a crash will happen is nearly impossible. Lesson number 3. Have a long-term investment strategy. Staying invested over time can help ride out the storm and recover losses. Lesson number 4. Understand the impact of emotions on investing. Fear and panic can lead to poor investment decisions. And lastly, learn from history. Studying past market crashes can help us better prepare for future uncertainties. Let's remember these lessons as we strive to protect and grow our wealth during turbulent times. I hope you found these insights valuable and encourage you to apply them in your investment journey. If you enjoyed this video, please give it a thumbs up and subscribe to my channel for more valuable content. Remember to hit the notification bell to stay updated whenever I release new videos. If you have any questions or comments, feel free to leave them down below. I love hearing from my viewers. Thank you so much for watching. My name is Parul and I will see you soon in my next video. Bye!